Hi, this is Mr. Evans. This video is going to look at income statements. So we're looking at how to undertake a SWOT analysis, how we identify the internal position of a business to assess strengths and weaknesses through financial ratio analysis. But before we can get into financial ratio analysis, we need to understand these financial documents, the balance sheet and the income statement. So we've looked at the balance sheet, and I said in that video that you sometimes hear celebrities being asked a question or celebrities, being said, this celebrity earned this much last year and they're worth this much, and there'll be different figures. The balance sheet answers the question, how much is this business worth? If this business sold off all its assets and paid off all its debts, how much money would be left over? That is how much the business is worth, and that is identified in the balance sheet. The income statement is different from the balance sheet. The balance sheet, for starters, is just a snapshot in a period of time. If they sold off all of their stuff today, paid off all their debts, how much money would be left over? The income statement is a record of a period of time, usually a year, and when a company publishes its annual report, that income statement will cover the year. And it is a formal financial document that shows the value of a firm's revenue over 1 year and the costs involved in generating that income. It shows whether a business has made a profit or a loss. And in fact, they used to be called profit and loss accounts, but they've part of it being a formal document means that there is regulations, particularly for public limited companies, about how they present their income statement and the language that needs to be used. So the important thing is it compares revenue to costs, and it allows us to identify whether a business has made a profit or a loss. And again, there's a lot of terminology that you need to understand about the income statement. Some of this you'll be familiar with from the AS unit, but it's worth remembering, going over, and just spending a lot of time really ensuring that you know what the different components of the income statement are and what it's telling you. So we've got the income statement. It will detail sales revenue or total revenue or revenues. It can be called a number of things, but revenues are the total amount of money that is earned from sales, the day-to-day operation of a business. It's important to separate revenue from kind of one-off income that a business might get. Like, for example, if it sold a factory, that's not going to be counted as revenue because it's not money earned from the day-to-day operations of a business, the sales that they're making. So revenues are the money that's earned from kind of the normal activities of a business, selling its stuff to its customers. We then have the cost of sales, which are the variable costs of production, the raw materials that are used to make the product, transport the product to market, the packaging, etc. All of that is the cost of sales. And when we take total revenue, or when we have the total revenue and we subtract the total cost of sales, that gives us our gross profit. So once we've calculated our gross profit, we need to know our fixed costs, how much our fixed costs were. And these are called expenses or overheads, our fixed costs of production, the things that we've got to pay regardless of how many units we make. So for example, rent, advertising, managers' salaries, all examples of fixed costs of production. So we've got our gross profit. We know our expenses and overheads, and when we take away our expenses from our gross profit, that will give us our operating profit, which is arguably the most important item on the income statement, because it details, right, this is how much we sold in our normal day-to-day activities, these were the costs incurred, and we're either making a profit or we're not. However, businesses do earn other revenues and expenses, like selling one-off items, like maybe a factory, like I mentioned before. They're going to have to pay some tax. They're going to maybe have some debt repayments to do as well. So all of these need to be accounted for. And when they have been, we've got our profit for the year, which is our operating profit minus our other revenues and expenses. Finally, it might be interesting for us to know how that profit is utilised, and businesses can really choose to do two things with its profit. They can either reinvest it into the company, buy new assets, employ new staff, spend it on staff training, etc., or it can be paid out to shareholders as dividends and reward people for investing in the business. So let's have a look at an example to bring this home. And again, it's worth just looking at as many of these as you can. Use the textbooks, use the internet, go in and see some real examples of these, and just have a look through and see what you can tell. So let's just talk through this particular example. It's a very simple one that I've done. This company earned 100 million in revenue. All right, and there's the formula for revenue there. The variable cost of production, cost of sales was 60 million. That left a gross profit of 40 million. They had on top of that fixed cost of 20 million, which left 40 minus 20 equals 20. These brackets here signify that this is money going out of the business. The revenue is the money coming in, of course. So there's our operating profit. This business is indeed profitable. So once we've done that, we need to account for other revenues and expenses, or other income and expenses. So they've had some finance income, which might be money earned from investments, so shares they have in other companies, or interest earned on money in the bank. Okay, so that's there, and maybe they've borrowed some money as well. So 15 million on debt repayment. So 20 plus 5 equals 25 minus 15. They are left with £10 million profit before tax, and we can then calculate how much tax they pay. Corporation tax is actually now charged at 19%, but 20 is what it was up to April 2017. It's now 19%, but 20% is much easier to work with. So we'll say they paid 2 million out in tax, which gave them 8 million profit for the year. Well, the final bit of the profit and loss account is up to the board of directors what is to be done with that. I mean, there might be pressure from shareholders, etc., but it's essentially up to the board of directors to decide what to do with that profit. And in this case, they've decided to distribute 3 million to shareholders in the form of dividends, or you can even pay out some of that money as employees' bonuses in profit sharing schemes. And they have decided to retain 5 million of that. Okay, so money reinvested in the business for future use. So that's how a full income statement might look, and they're even more complex than that when you start looking at them in sort of the company's annual report. This is an example of one taken from the 2017 exam. So you can see that they've eliminated a lot of the sections there, and they've only given you certain parts for you to look at. So they tend not to be so complex, but you've got to be prepared and you've got to understand all of those key terms, because you don't know what the exam board is going to give you. So what are the purposes, or what is the main purpose of an income statement? Well, number one, obviously we want to see if the business is profitable or not. Number two, we can start to judge how efficient a business is in generating profit. So this is where our ratio analysis is going to come in, and I'll talk a bit more about this point in subsequent videos. But in fact, you've actually looked at this before in the AS course, when you looked at gross profit margin, net profit margin, and profit for the year margin. And that tells you how efficient the business is at turning revenue into profit. Income statement can be used to monitor sales, monitor costs, and judge any progress that has been made towards achieving a business's targets, maybe in terms of sales revenue targets or reducing costs. we can judge the extent to which an organisation is investing for long-term profitability. In other words, is a business shelling out the majority of its profits to shareholders as dividends, which could be argued to be quite a short-term tactic to keeping investors happy, or is the business investing in new assets, not giving out so much in dividends, and ploughing money back into the company so that they can be profitable in the long term? An income statement allows shareholders to compare investment. So, do I want to put money in this company or this company? Which one will earn me the highest returns? We can judge performance over time, so we can compare against previous income statements. We could also judge the performance against competitor firms, so we can look at Sainsbury's income statement and compare it to Tesco's or Asda's or Morrison's or whatever. And the income statement will have different purposes for different stakeholders. For example, employees will want to know how much profit the business is making. Is my job secure? Do I deserve a pay rise? Is the business being fair in terms of, I'm working really hard and they're making this much profit? Am I getting a fair wage? Customers might use it to see if the business is likely to survive in the future. Customers tend to want to buy from businesses that are going to be around, or things like guarantees might run out. And shareholders, we've already talked about how they would want to get a return on their investment. Finally, again, acquire investment or even loans from the bank. An income statement is going to be really important in persuading someone to either invest in you or lend you money. They want to know that's going to be a worthwhile investment. They want to know their money will be paid back. So that's income statement. Really worth taking some time to go over them in detail.